right, welcome to another episode of the Hustle Harder Show. This is James Gaskin, as always, and we've got my esteemed co-host, Kevin Werner.
Esteemed? All right. Very excited to be here with you, James. Here we go.
I hold you in high esteem, Kevin.
Me too.
And I think the rest of the industry does too.
Well, thank you for saying that. I hold you in very high esteem as well.
All right. Well, this isn't a compliment contest, so we can move to Brett. Brett Sims, Renovo Financial, head of growth. Brett, you do a lot of different things for Renovo. Like myself, I think we have a fairly wide-ranging role. Tell everybody a little bit about what you do at Renovo and just a brief intro.
Sure. Thanks for having me on, James. First time I've been on one of your podcasts here. It's exciting. Very fun. So what do I do at Renovo? Good question. Spent a lot of time with you and with Kevin. I typically describe kind of my role as about a third of my time spent with loan officers and clients and getting out into the markets and talking on the phone and just kind of getting a good sense for what we're feeling. A third of my time with kind of our credit side. I know you heard from Darren last week, as well as a capital. So combine those into two. So how do we match what our loan officers are seeing in the market, what the clients need, to kind of what we can do on finding money and credit box, et cetera. And then a third of my time, just general things. A big portion of that today is our larger balance, what we call Resi CRE. So larger ground up, multifamily value add, larger perm loans, kind of in that $3 to $20 million space is where another third of my time is. So my favorite part of the job is really talking to clients, figuring out deals, seeing where we can be helpful, and then trying to match up the different pieces of the business to deliver that.
Yeah, and I think what's really interesting about your role and your perspective that you bring to this conversation is that your role really spans all the way from the street, talking to the customers on a daily basis about deals, and then translating that straight to the capital markets aspect. So you sort of touch both extremes of the process, I think, the deals and the money. And I think that puts you in a great position to have an interesting perspective on what's happening in the world and then really how it directly affects our customers. So really excited to have you on and to get your perspective on things. This is the second time we've done this show. I see you guys didn't dress up, but that's okay. I'm teasing.
It's gonna be 80. It's gonna be like 80 degrees in Chicago today. Come on, you gotta get dressed for the weather.
I am teasing. I'm teasing. Of course, we have a very casual dress code at Renovo. I'm dressed up today because I'm heading to a conference after this, and then
Wait, you have like a dress shirt? It looks like you have like a long sleeve dress shirt on.
I do have a long. So my jacket is hanging over here.
You have pants to match that shirt, or you have like running pants on?
I'm wearing jeans. I promise. I'm not going to show you, but I am wearing jeans. And I'm wearing boots today. I'm wearing some cowboy boots.
Texas style.
This evening I'm attending some of the sine die parties for the closing of this year's Texas legislature with my wife. So gotta get the boots on. This is a boots wearing crowd. So I had to wear the jeans to go with the boots.
Very cool. Don't tuck your jeans in your boots, right?
Don't tuck the jeans in the boots. That's unless you're out in the field. That's a no for sure. But fashion aside, excited to dive in today. Let's talk a little bit about what's going on in the news. Anything pop out to you guys over the last week that you think has extra implication for our clients and real estate investors in general?
Fannie Freddie possible news, which might impact us. I know that was one thing.
Yeah, let's jump into that real quick. So there was some articles, a lot of reporting lately about the Trump administration talking about privatizing Fannie and Freddie. And for those who don't know, Fannie and Freddie were private. 2008, great financial crisis. The U.S. government took those two companies under, I don't know, receivership. I'm not sure what the term is, but basically took control and took what was an implicit guarantee, right? In the past, the market looked at Fannie and Freddie as being effectively backed by or guaranteed by the federal government, with the expectation that if something happened, that the government would step in and backstop the guarantees on those consumer mortgages, right? So Fannie and Freddie basically sits, they're a middleman, they buy mortgages, they package them up, they sell them as securities, and then they guarantee them with, in the past, the implicit expectation that the US government would back them. Then great financial crisis, US government takes them over. Then there's an explicit guarantee. And the idea is now raising some cash to reduce the deficit, the US deficit, by selling shares in Fannie and Freddie, effectively privatizing them, and maybe going back to that implicit guarantee. What, if any, implications does this have for the housing market? What could this do? I think a lot of the reporting I read, there were some concerns that this could increase interest rates because buyers of those securities would not necessarily have that explicit guarantee from the government. Although, the thought process is that guarantee would still remain. So that could move rates and yields higher, or spreads higher, creating higher interest rates. Do you think this is a good thing or a bad thing for the U.S. economy? It seems like it's been working, but what are your thoughts?
They've been talking about this for a long time, pre-Trump 1.0. I think it's volatility. I don't have the right exact facts in front of me, but I think Fannie and Freddie buy the vast majority of mortgages and package them up and just provide liquidity to the market. So privatizing, I assume liquidity would still be there. You're right, James. If you move from explicit back to implicit, does it change the pricing? Does it change the liquidity structure? I don't know. I mean, these things, they seem to have come back around from where they were on death's door in the GFC. I don't really have a strong view one way or the other of what's going to happen, other than just it's another wrinkle in the volatility of today's world of who knows where things are going.
Well, I'm wondering if they could, there's been these rumblings of a, what do you call it? A U.S. sovereign fund. Could you put these as a cornerstone asset into a U.S. sovereign fund and start, thinking of ways to build, more AUM, in a way? I mean, I don't really know what I'm talking about here, but there's been talks of a U.S. sovereign fund. It's hard to have a U.S. sovereign fund when you owe $35 trillion. But you could, I don't know, it'd be kind of interesting to see if someone can start it with big assets like Fannie and Freddie and build an asset, premier asset gathering business called U.S. Sovereign Wealth Fund.
That's an interesting wrinkle. I hadn't really considered that aspect, but I like where you're headed with that. I think some of the criticism that I read about was, specifically the discipline that exists when you have those types of really, those two organizations are cornerstones to the liquidity in the housing market, right? Brett, you were touching on that. When the US government owns them, historically, the world has viewed the US as a great place to invest, right? Especially the US housing market. It's one of the largest asset classes in the world. So when you have the federal government backstopping those mortgages, that becomes a very, very attractive asset. But the other aspect is the discipline that the US government is not necessarily motivated by profit. And when you basically privatize the returns from an organization like Fannie and Freddie, but then you socialize the losses, then the people running the business kind of know that they can take risk and that they're going to get bailed out if something happens. And a lot of people cite that lack of discipline in allowing mortgage standards, credit standards for consumer mortgages to float beyond the point where, they then started to create a pretty big concern. And then, of course, we realized that concern in 2008, 2009. Do you guys have any concerns about the effectiveness of those organizations and the trust that we have to place in them because of the role that they play? if they go into private hands and you start to see some of that more profit motivated behavior that maybe doesn't fully account for the risk or the lack of conservative underwriting?
I think you always have the moral hazard issue in there. But the flip side of that discipline, James, is it's subject to policy. Now, I will say, like the invention of the 30-year mortgage, which I believe is pretty unique to the United States. Like, I worked for a Canadian company for a long time. That is not how they do. They reset those mortgages every 5 years. It is not as competitive. You don't call a broker and get them to get the best deal for you, whether it's agency or otherwise. Is pretty important to supporting and creating wealth in this country. So I think the best thing we can do is have some type of, you got to have rules, right? Capitalism is great, but it's got to have some rules involved. So whether it's private or public, or as long as there's the proper rules involved, then you don't end up with that moral hazard issue. That was the big part of the GFC. I think there's utility there.
I hadn't thought about. That's a good point, James. I really hadn't thought about that. Having it, hats off to whoever has been running Fannie and Freddie for the last 10 years, because they've kind of kept it on the straight. They've kept it clean. They've kept it, pointing straight forward. They haven't gotten into, many ancillary products or anything, which is kind of good, right? They've kept it really clean, and you could see that if it was public or had a profit motive different, that they would maybe start doing things differently and put at risk the those organizations. I hadn't thought about that.
Yeah, I think the compelling thing that I was kind of looking at was that it has been working. Seems like it's worked really well with those organizations under, government control, right? And so, obviously there's a financial motive to privatize because it's an opportunity to raise capital and really kind of reset the balance sheet a little bit with regard to those two very large organizations. So I can understand it, but it seems like it's been working. So it's kind of like one of those, do you really want to upset the apple cart and do something different when this solution seems to be working really well? And when, we've seen how it can go the other way in the not so distant past, although probably distant enough where people aren't, waking up with the nightmares of the great financial crisis like they were, in the 10 years post. Maybe memories have gotten a little fuzzier and we're starting to come back around to that same thinking. But it definitely seems like it introduces risk at the very least, like a little bit. And I think that's the thought process for higher mortgage rates, right? Because the market will see that and go, okay, well, it could work. It has worked in the past, but it's also blown up. How does that affect the long-term health of the U.S. housing market? Well, really those mortgages, that there definitely could be an uptick in rates, which of course is the opposite of the news that most of our clients and probably listeners are looking for.
High rates are bad. Let's not go that way.
High rates are bad. Indeed. Well, very interesting one. I think we're in the early innings of this issue. So, we'll see kind of how things progress here and what the rhetoric looks like. But it seems like it's a very plausible thing to do. And Brett, to your point, I think, that was a really good addition there that, they have been talking about doing this for a long time. And the takeover of those of Fannie and Freddie by the U.S. government was always meant to be temporary. It was not meant to be permanent. So I think that's contributed to the thought process that eventually they would roll back into private hands. But it seems like there's a lot more to hear on this one. So we'll monitor this issue, but it seems like it could be interesting and certainly could impact, real estate investors as far as the mortgage rates that their buyers on the other end would receive. Let's move on. I was listening to Housing Wire Daily this morning, actually, and Logan Mohtashami, one of the industry's dedicated economists, was talking about there was a lot of talk, in about a month ago, maybe about Trump wanting to fire Fed President Jerome Powell because he's not lowering rates, which is what Trump would like to see in order to spur the economy a little bit and show some progress on some things. Powell has been reluctant to do so, and I think was it Friday we had some inflation data come out. Brett, talk to us a little bit about what the inflation data that came out on Friday, is suggesting about the health of the economy and inflation in general.
So the PCE, which is, as it gets caveated everywhere, the Fed's preferred inflation measure, came in pretty much right around 2%. I think it was at 2.1. And the Fed's dual mandate is full employment and inflation at 2%. So it appears that inflation side of the equation is coming into focus of where they want it to be on a core basis. I don't know. There's, again, I hate to use this word volatility, but you've got, inflation starting to look decent, but you see unemployment kind of hanging in there. You see consumer delinquencies ticking up. I think there's just a lot of noise, tariffs on again, off again, that makes it very challenging for the Fed to think about where the future is pointing. And so they're kind of in a wait and hold pattern, which clearly is not where this administration wants them to be. But that is where I think a lot of the data points were saying, hey, maybe we shouldn't be doing anything right now.
When does his term end? When does Powell's term end?
So it ends in 26.
26.
Yeah, I know. But do you know when?
Yeah, I think it's fall of 26.
Oh, shoot. Fall of 26?
I believe so. Could be wrong. That's a quick Google search.
I mean, that's going to, there's no way Trump doesn't put somebody in there that,
I think it has to be somebody who's currently on the board, gets elevated. Again, I could be totally wrong. Here's our caveat from last week. I'm not an economist. We could do a bit of research. Yeah, you're right. It's going to be very interesting of who the next the chairman of the FOMC is going to be.
So the Supreme Court came out with a decision recently where they basically said that Trump could fire certain heads of departments and commissioners, et cetera, but they explicitly, and I think in some ways, they overemphasized that the Federal Reserve was off the table, right? That he could fire some people in certain departments, but the Federal Reserve was not to be touched, and that separation was an important one for the health of the U.S. economy. So basically, Trump got told no, can't fire Powell. So obviously, that's not what he wants. So the Housing Wire podcast this morning was talking about a concept where Trump basically can institute a shadow Fed president. So because Powell goes out in 26, he can't fire him. Instead of being able to do that, effectively, he's going to come out and say, hey, this is my new guy, whoever that is. And there's somebody that he's brought up. And I think you're right, Brett, but I'm not 100% sure that it has to be somebody on the board. But he's got a friendly person that he wants to install, and to basically come out and announce that, and then have that person come out and message to the market that, hey, basically, we can't control what's happening now, but as soon as I'm in the seat, we're cutting rates. And hoping that messaging actually moves markets now, because he's not confident that the Fed and the current chairman are going to do so. And based on the inflation data that you just cited, Brett, it sounds like what the Fed is doing currently is fairly supported by the data. It's not like the Fed's holding rates despite all of this information that would suggest that they should cut. It seems like the job is working. So the data doesn't necessarily support, at least in this context. Now, I'm sure people can come up with other data points that they would love to have introduced into the conversation that maybe supports their view, but that it seems to be working. So it'll be interesting to see how Trump plays this, but definitely I think it's very likely that this kind of shadow president concept could come to fruition as a tool, right? And one of the only tools maybe he's got to move the markets. Is that good? Is that bad? Does it matter?
May of 26 is when Powell's May. So the countdown has begun. Less than a year.
It's interesting. I don't know. The bond market's going to probably enforce discipline, whether or not this person comes out and says it anyway. You got the tax bill that's winding its way through has impacts. I think there's a lot more than just one data point of a guy saying I want to lower rates. I think it would be. It's a novel concept. It could be really interesting.
Yeah, I mean, I think there's a good chance we see it play out, right? Because it does seem like the kind of move that Trump likes to make, which is he's a marketer, right? At the end of the day, the president of the United States is a master marketer, and this is a marketing move, right? It's all about messaging. If it does indeed go this way, but certainly Trump seems to be. It's all but implied, right? Everybody knows that whenever Trump gets to make his nomination, and whoever the next Fed president is going to be is probably going to be somebody who's on board with his agenda, and likelihood is that means cutting rates. Kind of, I mean, hopefully data supports it, right? But that doesn't necessarily mean that would be the case given some of the other things we've seen. So it'll be an interesting one to monitor. But on the positive side, inflation does seem to be under control, and I think a lot of people believe that we probably wouldn't even be talking about inflation if it weren't for the trade war that we've gotten ourselves into, right? Like that's an regardless of what people think. I think trade wars are inflationary, and tariffs are inflationary on some level. So what. That's probably a major driver of putting the Fed in the position that they're in. Fed might be in a position to cut rates if they really wanted to, but it certainly doesn't seem to be driven by inflation, even with some of these inflationary policies. So definitely one to watch, but another one that could certainly have impacts on bond prices and therefore the cost of borrowing. So I think that one's a pretty interesting one. Definitely one we should come back to. Here's one I think you guys may have some thoughts on. So over last week, I believe JP Morgan CEO Jamie Dimon came out, and there was an article in the Wall Street Journal about his prediction that if we kind of continue on the similar path that we're on, I think regarding tariffs and other policies, that deficit related things of that nature, that you could start to see some cracks in the bond market. The bond market is certainly really important for our customers and for the overall cost of debt financing in this country. Any thoughts on Dimon's proposal there that you could start seeing some cracks and create some issues with liquidity in the bond market? Are you familiar with the article? Did you guys read that?
Yeah,
I did see that one. Yep.
Well, let's hear it. Let's hear your thoughts. That's what we have you guys on for. Obviously, Brett, we didn't bring you on for your decorations in your office. You and Darren.
I knew
you and Darren have the same
you guys
decorator.
Make me a hard time about that. I was like, can I blur the background here?
Before long, we're going to get you guys all with a bunch of art on your walls, but we'll get there eventually. But yeah, let's what are your thoughts on the state of the bond markets today? Spreads and what are your thoughts on how this policy, kind of administration is pushing the market, and any concerns that you have over, liquidity or cracks in the bond market, as Jamie Dimon would put it?
Yeah, I mean, I'm not anywhere close to Jamie Dimon level here, or seeing all the data points he sees or talking to. He seems like a perma bear, which is probably good when you're running one of the biggest or the biggest financial institution in the country and always preparing for some downside risk. I think like what we've seen in the bond market, it seems to be holding steady in a band right now. But again, there's all kinds of, the long end has been selling off. It's been getting more expensive. They had a relatively difficult 30-year treasury issue a couple weeks ago. I just think there's not as much appetite for our long-term bonds. The government had been funding itself on short-term, which was great when rates were super low. Now that play doesn't work as well. So I think, the conventional wisdom is the bond market is going to force discipline on a lot of people, including probably our Congress and our president and what they have to say. And so as new deficits come out, how do you fund this? How do you how do you not offset tax cuts with revenue increases? Do you believe the math that GDP will grow enough to offset it? I don't know. The bond market seems to be saying probably not, although it's, again, be relatively calm the last couple of days. It just goes up and down in a band. So I don't know. If I had a crystal ball, I'd be sitting on a beach somewhere.
Quick question. How many times, what's the over under on the number of times the word volatility will be said on this show in the next 6 months? 100. I'm going to put
Easy.
a over
That's what
under
it
at
is right now,
100.
right? There's changing things every single day. There's nothing consistent. Our tariffs on, then they're off, then they're illegal, then there's an injunction, then there's a stay, and they're still on, and then there's changing to now it's 50% on certain things that are part of, by law. It's all volatile. Things are just moving up and down every day.
Is volatility a core component of the Trump administration's general strategy? It seems like the Trump administration likes to keep everybody on their toes. Nobody knows what's going to
Well, it's
happen.
their flood the
Is that-
zone strategy, right? Just
Yeah.
throw a whole bunch of stuff out there.
Yeah.
Keep everybody on the
We all
toes.
knew what we were getting. I mean, look, volatility is it. There's been very few periods of time where there's no volatility, and I think for real estate investors, for us as lenders, for anybody kind of in business for that matter, you have to be, you have to keep your seatbelt on and take some, you're ready for ups and downs, and that's what keeps it interesting.
It definitely keeps it interesting. That's certainly true.
Well, that's where you have to stay. That's where you have to stay disciplined, right? And for us too, it's who do we want to work with? What kind of credit? What markets? It's staying disciplined. I think the same things for our clients. You guys talked a lot of it last week, so I don't need to regurgitate. But know your market. What's the profit look like? Who's buying these houses? How do you? And you can ride through that volatility. And sometimes you'll win, grand slam, and sometimes it's singles and doubles. And I think we should take the same approach here. What do we want to be? What do we want to do? Keep your head down and focus. And something's always going to come your way that's going to cause, whether you're flipping a house or you're running a business, there's going to be a bump in the road somewhere. But if you're prepared and you're disciplined, you can usually ride it out.
Yeah, I think that's right. And one of the things I love about our business at Renovo is that I think we've, and Kevin, you've done a great job of instilling this in the organization, is this concept of discipline, right? Credit discipline. There's many stories of lending firms that grow at exponential rates for a period of time when the market supports it, but the discipline erodes. They start doing loans and taking risk they maybe shouldn't. The market turns and then they get caught, right? And I think, the goal at Renovo has always been to build a really long-term and sustainable business, one that would not be subject to as many of the peaks and troughs. If we can kind of stay steady, and a lot of that requires discipline when times are good, that you don't take on too much risk and get too aggressive, because those are the loans that could really hurt you if the market turns. And then when the market is down, also, being clear-headed and we use the term sober. But what does discipline mean inside of Renovo, Kevin? How do you think about discipline and how it impacts our business and the long-term goal of keeping a sustainable lending company that can be around for a long time?
Oh, that's a billion-dollar question there. I think it's the same for whether you're a real estate investor or a real estate lender, and take a really long-term approach. Be willing to get up every day and work on the hard things and have little wins. There's 1,000 details in all of our businesses. Work on those things every day. Move forward. Don't get too happy or too sad. It's something we talk about a lot here, is try not to get too overly confident or too negative when things go bad. Try to stay in the middle. Try to just stay focused on our goals and move ahead. At Renovo, one thing we've done since the beginning is we've set big goals, but we've said to ourselves, timing of those goals doesn't matter as much. We've set goals that say, hey, we want to do $1 billion a year in origination. We want to do $5 billion a year of origination, but not setting a timeline and then forcing those things artificially. You still have to make good loans, make sure we give great customer service every day, make sure we take care of our team, our, employees, new people joining the company, people that have been here a decade. Every one of those things has to be taken care of and thought about and moved along and not get complacent. You can kind of tell when company leaders take their eye off the ball, and you can't. There's too much going on every single day to take your eye off the ball. This is a full-time game. In the arena, working every single day on what's going on is really important.
Yeah, I think that's great. And the other thing that I think is really important as it relates to discipline with the investors on the street that are actually executing these projects is being disciplined about how you grow. And I think there's a lot of people I talk to all the time that are very successful real estate investors, have grown large businesses. And sometimes these guys are talking about, oh, well, in order to keep growing, I'm going to move into a whole new market that I don't know very well, or I'm going to move into this new business line or this new product that I've never done. And I think having discipline to really stick to what you are great at and where you have an edge, right, over the competition, and not, yeah, and I think inside of Renovo's business, we've done a great job. Now we have expanded some of the product offerings that we've done. Brett, you referenced our Resi CRE business that you've been instrumental in putting together. That's a really great complement to what we're doing and what we have been doing since 2011, which is financing, short-term and long-term real estate investor projects. But this allows us to do larger projects and work with our clients as they build and grow into new assets. But they've all been tangentially, related to the core business. And we've been able to leverage all of the work and the processes that we put into place for the core business to expand into a slightly different but related product. And I think a lot of investors on the ground have to be thinking the similar way, right? It's not a great time to go and get into, or I should say, it's probably not a great time to go and getting into a whole new business that you don't have that expertise in. Expanding tangentially and related things is sometimes fine, but you got to realize that there's risk in doing so. And especially when the market's really volatile, I think it's an important time to really stick to the fundamentals and what you know. Would you guys agree with that?
Yeah, look, we. I'm trying to think of if I'm a lender or an investor, and I think all of us kind of have some expertise in the area that we're focused on. And then depending on how big you want to build your business and how many people are on your team, you could start adding one new product. Go slow. Do one project. Test it out. See what happens. Then do two. It's really hard to have multiple products in multiple geographies, and the more things you add, the more complex your business gets.
Well, I think one of the things too that Kevin does really well, and I've seen some of our clients do really well, is when you do want to move into something or there's a new problem, you don't have to reinvent the wheel. There are people out there that can talk to you. You can get advice. You can find mentors. You can partner. I was talking to a client who is a New Jersey-based investor, but coming out of COVID, he saw some opportunities in Ohio, and he wanted to move into it. But he said, I don't really know what I'm doing. So he went and he found the top wholesaler, and he found some mentors that really helped him learn the market and what he wants to do. And now he's been investing in Ohio successfully. And I think the same thing for us. I think we're not afraid to ask questions, and we're not afraid to go seek out people who probably know more than we do as we think about how we can stay disciplined and manage our risk as we expand the product suite, go into new markets, what have you. It's realizing that naked adjacent, and be smart about it.
You're in finance. I think if you're in real estate or lending, you're using capital. You're in finance. I think even if you're in real estate, you're using capital. And there's a good old saying that there's no brave old men in finance, because you get killed along the way. You don't have to be brave. You know what I mean? You don't. There's not a braveness, or there is, and you could get your head cut off. And I think there's a carefulness and a thoughtfulness. Look for advice, as Brett said. Really try to find mentors. If you want to try to do a new product, someone's done it. There's very few things in the world, like we're not creating AI, right? The three of us knuckleheads are not creating. Maybe you guys are. I'm not. The kind of things that we're working on are not rocket science. People have done them before. So what we try to do as a group is go find people that have done it and talk to them. Hey, how'd that go for you when you did that? What worked? What didn't work? Ooh, that was smart. Wow, you got hurt when you did that. We should not do that. Same thing if you're a direct investor. If you're a fix and flipper today and you want to start in ground up construction, go network with some ground up construction people. You can window shop quite a bit. You don't have to take your life savings and go dump it into your next idea. That's being brave and stupid.
Yeah, and I'm glad you brought that up because I do think that, like Brett, your example of an investor moving into a new market, the ones that I've seen that do most, the ones that I've seen do that most successfully are people who are, number one, are very thoughtful about how they do it, but they also typically find somebody who has that expertise, and they either partner with them, they create some type of alignment that allows them to leverage that local expertise. Even if it means they make a little bit less money, it reduces the risk significantly. So finding people that have done it, that understand that particular market or that particular product, and then using that.
If you want to add ground up construction or some other element, go find someone who's retired. Create an advisory board. Pay them $500 a month to be on your advisory board. If you get $1,000 a month, pay them. Ask them for their advice. Take them to lunch. Spend time. It will. If you're not going to do that, wow, are you being a little bit reckless?
Yeah, and you've always done an awesome job of that. I know you have a lot of mentors and a lot of people in the space that have been around for a really long time that you have done a great job of cultivating, really good relationships with, and I think that's been incredibly valuable for Renovo.
It's been really valuable for Renovo. And look, it's something I did learn a long time ago by not going to college myself. Not that that's going to teach people how to do stuff, do a business, but there was a thing of having to figure out how to learn things. And if you're going to grow and add products, that means you're curious, I would think, or else you shouldn't do those things. Right? Just go coach your kid's basketball game instead of starting another product. You don't need to start more products. But if you do want to start more business lines and more products, I go find someone who's been doing it for 30 years. They semi-retired, and hang out with them. You are who you hang around.
One of the things we say too is crawl, walk, run, right? It's okay to crawl into it, figure it out, and then start building on your successes and learnings.
Don't be brave. Be tough and smart, but just be very careful on that.
It's like a fine line between bravery and stupidity, right? Or recklessness. And I think that's the more brave, the more into that brave spectrum you get, the closer you potentially get to recklessness. And I think that's really important, but definitely finding people that can help you. And I think, especially for investors, and many of our clients are running reasonably sized businesses, but they don't necessarily have dozens and dozens of employees in many cases, right? So there's certainly some that do, but I think also building an organization and a thought process that is being willing to admit the things that you don't know, being very aware of what you don't know, because going into something new in a volatile environment is dangerous. So if you're going to do it, you really got to go in there with a strong thesis, but also willing to beat up that thesis and how you could be wrong. And I think that sometimes that goes counter to the entrepreneur's mentality, right? Which is go fast and break stuff and then figure it out along the way. And that can get you in a lot of trouble, especially in times like this.
That's a great thing if you're maybe in tech, maybe that works. But if you're in real estate or lending like us, these are long-term commitment things you're taking a big risk on. If you go, I'm going to go gung ho and I'm going to build a 18-unit building and I don't know what I'm doing, but I'm just going to do it. Well, it could take you years and years and years to get out of that thing. And you're going to be so banged up and beat up by the time you're out of it. That's tough. So it's better to go a little slow. Same thing in the lending businesses. If you make some bad decisions, turning these things around once they start getting off course is hard. Really, it just takes years.
Yeah. No, I think that's totally fair. Real quick, we have about 5 minutes left here. I thought we could just, for a moment, because it is a big topic, a big headline, is maybe touch on the big insert adjective bill, the big budget bill that's going through the Senate right now. Any thoughts on that, on how that could impact our clients, on what that could do to our economy? I know right now it's basically going through the cleansing process where they pull out all the erroneous things that find their way into bills of that size. But any thoughts that you think would be valuable for the audience on the big, beautiful bill, as it's been termed?
It's going through the reconciliation process, so who knows? It's 1,000-some pages. I don't know if anybody's ever read the whole thing yet. So the sausage is being made. This is what government's supposed to do. And there's a lot of promises and things that are in there that who knows if they'll be in there when all is said and done. So what do I think? We'll see. If you continue to add, we talked about bond markets. The bond markets will not like continuing to add to the deficit without any kind of offset. And there's some math being used, depends on who you look at. There's, a bunch of different think tanks and government offices and things that crunch the numbers, who all come up with different results. But I think it's been consistent that there is a big deficit being added, and that triggered a sell-off in the bond market. Now I think it will come back in when it goes through the Senate process, but I just think it's still too early to tell. You've got the House is different than the Senate, and everybody has an opinion. And we'll see what the final thing looks like.
I think three things. I think one, more realistic than ever. I don't know. I am a little scared of our deficit. It's definitely just a scary thing that I don't know how to deal with, but to me, it's really scary. That's one, just facts that I think kind of intersects with this bill. Second is just letting taxes go up is obviously not a good thing. So this thing has to be addressed one way or the other. It would be pretty disruptive if taxes just sprung back to where they were. I'm not hoping for that. Third, I did, kind of hear last week that there's some additional things going into the bill that might not be great for us, in real estate capital. That is, foreign investment capital might start getting some different tax treatment than it has historically. And, we rely on foreign capital a lot in the housing market of America. And there is some things, if you can imagine the tariffs on goods, while there's some things that are kind of being talked about in the bill about taxing capital in a new way from foreign investors, which I even heard last week was causing some investors to pause for a second before before certain things. So that, I don't know where that lands, but something to keep our eyes on, that, if there's a change in foreign investment.
Yeah, there's a lot of foreign money coming in to support the deficit that we're running today.
Yeah, so it's a complicated problem. James, you should study this a little bit and
next week, you got to read all 1,000 pages and report back.
Yes. I will have my AI assistant get on that, ChatGPT, bullet point the big, beautiful bill for me. Yeah. And I think, Kevin, you make a good point. Like the foreign investment thing, I think is very interesting. Let's play that out for 2 seconds. If foreign investors are taxed differently, you would imagine fewer foreign dollars are coming in to the market, which creates,
or it gets more expensive. It might not leave, but it might be more expensive. And right now in our space, in the RTL securitizations, I don't know what percentage of the people that are buying those deals are foreign entities. I think it's a lot.
I think you're right. And so, that's right. That's a good point. And that's what I was trying to get to is it could eventually make borrowing more expensive because the capital coming in requires a higher yield to offset those tax, the lack of tax benefits or whatever changes in
That
tax
means
treatment.
hurry up and lock your rates with Renovo Financial today because they could be going up. So get your lock in now. Hurry up.
You got your free commercial in there. Good job. Well, guys, I think we're kind of right at our time here. I think this is a great conversation. Thank you guys both for joining. And Brett, we'd love to have you back on to talk more about the capital markets and how that impacts our clients. But thank you guys both for coming. Any final thoughts for our audience other than lock in your rates with Renovo?
Happy June. Let's go. Happy June. You got one more month to end Q2. Let's go.